Okay, so now we've selected which strike price to buy. The next question is which expiration month to buy. So here's the rules that I follow on this. I'm typically looking for 4 weeks more time than you need to be in the trade. Now, how much time do you need to be in a trade? Well, typically you can look back at the typical moves for a trade and say, you know, this stock typically moves for 2 or 3 weeks and then it stops, or moves for 5 or 6 days and then it stops. And that's typically what I'm going to look for. I'm going to look at what I expect to be in the trade based on historical moves, and then buy 4 weeks more time than that. Now, if you need to err, if you need to go one way or the other, if in doubt, buy the extra time. The cost of buying too little time is really not worth it. So I put here a remember. Remember, the cost of buying too little time is theta. And so every day you're going to be losing a little bit of money based on that theta. And so you want to buy some extra time. Now, there's a flip here. You can also buy too much time where there's not enough interest out there, and people aren't trading 8 months in the future. So you're going to have a harder time getting in and out of those options. So typically what it's going to look like is 4 weeks more time. And usually you can almost always say it's going to be next month. That's usually what it ends up looking like. So if you're trading in the month of March, and let's say that it's the first week of March, you're probably going to be trading April options. If you're trading in April, you're probably going to be trading May options, unless you're maybe in the last week of April. If you're the last week of April, you're probably starting to look forward at June options. And that's usually the way it's going to work. But 4 weeks more time is kind of the rule here. So let's take a look at an option chain here. And at the time of this screenshot, it's July. And so we're going to be looking really at the August expirations. That's going to put us 44 days into the future. And that was the option that we looked at in the last chunk here, where the price was $3.20. Now, if you want to go further in the future, that's fine. We can go to September. The cost on that is only $3.95, but look at the danger of it. Look at your open interest. You've only got 310 open interest. And so that's the problem with getting too far in the future. You start to have lower open interest. Now, you could trade this. And if you really thought you were going to be in the trade for 4 or 5 weeks, I would actually go on out and buy September, even with the lower open interest, because by the time we get to September, by the time you get to the point where you want to liquidate it, you're going to have the extra open interest in there. You can look historically at a stock. Look historically at what the options typically do right at the month of expiration, right before that. And you're going to be able to get an idea, does the open interest come up? And if it does come up, then it's okay to trade less than 1,000 if you know you're going to be in the trade for a while. But if you're expecting to be in the trade for a week or two here, don't go buy 4 or 5 months worth of expiration, because it just doesn't serve you, and it's going to be a lot harder to get out of it when you do want to get out of it. I've run into this with students who go out and they'll buy a year's worth of time. They'll go buy a leaps option, for example, and they're going to be in the trade for, in their mind, maybe 2 or 3, 4 weeks, but they buy the leaps option because they think, well, it's going to have a lot more stability to it, and it's not going to have all the time decay. Well, then what happens is in 4 weeks they want to sell it, and it's still a leaps option. And if you go look at the open interest, there's hardly any open interest on it, and they can't liquidate the trade. I have an example from a student a few years ago. She had the same scenario I just described to you. She'd been in the trade for 4 or 5 weeks. It was actually a profitable trade. She wanted to get out of it, but when she went to sell it, she couldn't. And she had the trade open for like 2 or 3 days, and nobody was buying the option. And so I went and I looked at it, and I said, how many contracts do you have? She had 5 contracts. And how much open interest was there? There was 5 open interest. She controlled the entire market. She had the entirety of what was out there. Nobody else was trading this particular option except for her. That's why she couldn't liquidate it, because no one wanted it. And so she just simply had to wait for a little while until she could get out of the trade. That's the cost of buying too much time. So again, about 4 weeks in the future, beyond what you expect to need, is going to be ideal. Let's take another look here, and I want to show you, I've put another month's worth of time on the screen, and you can see the October expiration actually has plenty of open interest. So the August expiration has the open interest. October has it. Why would September be so low? Remember, we just saw that September was only 300 or so. The answer is the September option was just released. October was released as a quarterly earlier in the year. The September was just released, and it's taken a while for that open interest to get built up. But it will build up. That's why I say it is okay to trade that September in this scenario, because you can look ahead and behind a month and see, hey, that open interest is coming in. This isn't a stock that people aren't trading. You'll be okay with that. So this was an example that I wanted to show you. I thought it would really help you out kind of seeing that there.